Hey everyone, it's Daniel here from Infravest. Hope you're all doing well. So today I'm gonna do a special video. Had someone comment on the UK video that I posted yesterday. So I think it's from someone. If I get your name wrong, if I say it wrong, I'm very very sorry. Please feel free to correct me in the comment section. But I think it's A2A Felipe. The First of all, thank you for commenting and thank you for you know, giving your views. And I think I believe you live in the UK and you have a question about what would someone do with the current situation that we're in and with the possible risks that we could see, and how would someone structure a portfolio in this kind of scenario. So first of all, I just want to say that I'm not a financial advisor, I'm not a financial guru or any of that sort. So these are just my opinions, and always reach out to a professional registered investment advisor or financial advisor to get advice. But I thought this question was very interesting, and I think it's pretty interesting to see, just cultivate a kind of a mock portfolio of what something would look like in the current environment, and let's back test it. Let's see how the strategy works if we were to look down the road 6 months, 8 months from now, how the markets play out and how this type of portfolio would play out as well. Now, for someone who's invested in the markets, typically your time horizon would be long term. That's what I'm going to go with the assumption with, that your portfolio that you've structured for yourself is probably long term. Portfolio that I have and that everyone has, or may have, I should use, is more structured for long term, for your retirement, so that later down the road you have some cash that you could use when you are not working anymore. So what would you do in this kind of scenario, right? If you see that there are red flags, red sirens, red signals coming out from left and right, and it's not looking pretty. Honestly, the best answer that I would have is accumulate cash. Because and you mentioned that you have sold some shares and you have accumulated a good cash position, so that if we do sell off, right? Again, I'm not a guru that can predict how much we're going to sell off by, or where we're going to sell off to, and I can't predict the bottom, and I don't think anyone can either. But definitely we can read macro data to determine whether things are showing signs of cracking or things are looking like things may get better, right? So I'm more leaning towards the side that things are showing signs of cracks, and if these cracks get bigger, then simply it's just going to burst, and something's going to burst. What is that something? We'll find out in the future, if there is that something. So again, how do you prepare for this? It's very murky waters. What do you do? Do you make a bet? I mean, if you look in the current environment that we're in, all asset classes that you could think about to invest in are basically down, right? We have high inflation, and around the world, in Europe, UK, in the US, Canada, and so on. High levels of inflation that we haven't seen in a very long time. And you would think certain asset classes, like, for example, gold, that comes to mind, would do well. Or real estate, which is an inflation hedge, would do well, right? You could look at REITs. But if you actually look at the REITs or the real estate stocks or the gold stocks or the gold ETFs, if you like, or gold futures, they're all down. They're all coming down. and mainly because of the recession fears. That's plain. And even oil, even crude oil, right? We saw crude oil, and I'm talking more about WTI crude oil. I believe that in the UK you follow more the Brent oil, but WTI, the US index oil, um, which I follow a little bit more, went to a high of 130 and came down. It's now, I think it's now sitting around $82. So yeah, it's around $82 as we speak. And it did come off, it made a low around 76, and then now it's bounced up to about 82. So seen somewhat of a pickup, but that's quite a big drop from 130 down to 76. So even in that scenario, you would think that okay, when before the Russian invasion in Ukraine, and even a little bit before that, we saw oil really skyrocket, really move up, and that was one of the best performing assets in this inflationary environment. But what do you do now, right? Because that sell-off we saw from 130 to 70, 76-ish or so, that was more on a play of, yes, you could argue the SPRs, which are the special petroleum reserves that Biden is pushing out and releasing just because, midterm elections is coming up just a month away, and there is a correlation between whether you're going to win votes or not, and it all depends on oil prices. So if oil prices are high, you're less likely to get votes. If oil prices are low, you're more likely to get votes. So we're seeing Biden do that. We've seen Biden going up to Saudi Arabia telling them, hey, pump more oil, bring the oil prices down. And then on top of that, a combination of recession fears that is pushing the oil price lower as well. So what do you do, right? If we do get this big event, what if we get a 2008 type of event? Everything's going to sell off. Oil, gold, equities, currencies, aside from, I would say, the US dollar would probably on a safe haven play, may rally. Now, if you look in the current environment that we're in right now, US dollar continues to rally and do well while all the other currencies out there against the US dollar have been coming off. Right? You can look at the euro, the pound. You can even look at emerging market currencies that are in big, a very big problem for them, especially if as the US dollar continues to move up, it's going to create a lot of pain for them, and it already has. If you look at Sri Lanka, look at Pakistan, and so on. So, what can you do? Well, if you're already invested, now the thing is, the biggest thing that comes down to is your time horizon. If you've got a long-term portfolio and it's for retirement purposes, you generally don't want to play with that portfolio too much. You can hedge it, definitely. Just like the same way that when you purchase a car, you purchase insurance on the car, that in case, for God forbid, knock on wood, nothing happens to anyone, but if you were to get in a crash and then, the crash costed somebody's life, and then there was, some lawsuits which ended up being in the millions, right? No one can all of a sudden just pay $1 million for that lawsuit. That's where the insurance, or hopefully the insurance, will come in and protect you for. So you can do the same thing with your portfolio. So even if you have equities, even if you're still invested in stocks, what the wealth management industry likes to do is, their motto is all about time in the market is better than timing the market. So I'll repeat that again. Time in the market is better than timing the market, because if you're timing the market, no one's a genie that can predict the top or the bottom of any market. So if you try to do that, definitely you could see down the road long-term returns, especially if you're expecting it 20, 30, 40, 50 years down the road for retirement. Probably you would mess up the expected returns that you're expected to get in the future. So especially if you're trying to play around with your long-term portfolio. So what does it mean that time in the market is better than timing the market? Time in the market just simply means that stay in the market and keep accumulating as prices dip, and to you, as if your risk tolerance can handle it, and you can handle the fluctuations and stomach it, then whenever the opportunities present itself, you can buy these dips, because you know 10 years down the road, 20 years, 30 years, 40 years down the road, the economy is going to do fine. The central banks and the governments are going to come and bail out whoever needs to be bailed out. You see that in history, time over time. They're going to come out, stimulate the economy, print more money again, and push for more easing policies rather than tightening policies, and probably start cutting rates, buying bonds again, and push kind of markets into a higher direction. So if that's what you have already, if let's say if that's something that I have in my portfolio already, then definitely, don't want to play with that. But you can hedge it, right? You can hedge it. You can buy an insurance policy on that portfolio, right? The same way that you buy an insurance policy on a car. And that insurance policy could be utilizing options, right? Options come into mind. You can purchase, let's say, for example, put options, right? So if I were running my, let's say, made up portfolio, let's say here, I'm already invested in some equities. What I would do is I would look at my portfolio and see, okay, which are the stocks or the indexes or the equities that are high at risk, and kind of do a damage control and kind of cut off certain losses so they don't deepen more, and I can keep some cash on the side, because definitely, for sure, cash in this environment is going to be very, very important, right? So keeping some cash there, getting ready for some cash, and if you're working and you're getting a paycheck, definitely keep stashing cash on the side. And if you have it in, let's say, US dollars, then great, because your US dollar cash position is anyways going up as the rest of the other currencies are falling. So if the British pound continues to fall, and you have US dollars and you're making, let's say, money in pounds and converting into let's say US dollars in your investment portfolio, then you will see that after a while that you're kind of getting a gain from there, as well as the dollar continues to move up. If it continues to move up, right? If it turns around the other way, then you're on the wrong side of the trade. So definitely keep some cash. You want to have, if I were to make this portfolio, have some cash there, and do some damage control on the equities that are kind of under a lot, and keep that cash aside. The other thing that you can look at as well, so again, in constructing this portfolio, is not only looking at put options. So put options on what, right? Put options, sorry, I didn't clarify on a put option, so I'm just going to repeat that. Put options on equities, right? Put options on equity indexes, right? So it could be, let's say, what I follow, the S&P 500, NASDAQ, Russell 2000, Dow Jones. It could be put options on the SPY or QQQ that I will purchase in my portfolio to hedge against a big liquidation event, right? Because when you look at past recessions like 2008, 2000, and so on, you have this slow sell-off, and then you've got this liquidation event where just boom, low liquidity, low volume, we're just selling off hard. So with put options, if you were to have that in your portfolio, then and you could use that as an insurance policy that if the markets were to dip, then your positions which you're long in will have some cushion because of the put options. And when, especially when a sell-off happens and volatility increases and the VIX increases, then definitely, you'll see those put options really move up in value. And the reason why they move up in value is because of the volatility, the implied volatility that shoots up, which causes your premium that you paid for those options to really shoot up because the VIX is moving up and because the markets are just plunging. You're just seeing a massive drop that just happens all of a sudden. So definitely, layering in with some insurance policies like put options can definitely help. There are also other methods and methodologies as well, like looking at inverse ETFs. Some of the inverse ETFs could, again, on the equity indices, like for example, S&P 500, NASDAQ, Russell 2000, Dow Jones. There probably might be some inverse ETFs as well for the European indices or for the British, the UK indices as well. So for me, what I would be looking at is I would be looking at either the SQQQ, which is an inverse ETF. Basically, the markets will this ETF will go up in value when the tech index like NASDAQ or the QQQ is selling off. So it goes up, these inverse ETFs, they go up in value when you have the markets sell off. So that's one is the SQQQ. The other one is SPXU. SPXU tracks the S&P 500, tracks the SPY. So the SPY is selling off, then you'll see the SPXU shoot up as well. And then there's other ones as well. There's a pretty interesting website you can check out. It's called etfdb.com. etfdb.com. It's ETF database. That's and I think it's now, they call themselves now Veta FI. I think they got bought out. But the link, the URL, and I'll post the URL in this description here, is etfdb.com, and that can give you a universe of a bunch of ETFs, and you can filter it by regions. You can filter it by either equities, bonds, and so on. Now, the third thing, where am I on the second or third? I don't know, but let's call it third. The third thing that is very interesting, that what I started to do in my portfolio, is to buy up some bonds. Now, the thing is, and you mentioned you bought some UK gilts. If you look at bonds and bond prices, they've been selling off quite a bit. And shorting bonds as a tactical short-term, medium-term strategy is an overcrowded trade. So eventually, when things start to blow up, and eventually this overcrowded trade, a lot of people will start to get out of this trade. And when a trade starts to get overcrowded and it reverses, the people who are short are going to end up panicking and getting out of the trade. And if they're short bonds, then to get out or cover your position, you have to click the buy button. So I see bonds as a potential good opportunity to buy because of two reasons. You could buy actual government bonds. Like for example, let's take the 2-year US Treasury bond that is paying you 4+% on yields over the 2 years. So you can buy those in as a safety net, because if you look at everything else, everything's selling off. And yes, if bonds continue to drop in value and you actually buy government bonds from the government or from your broker, then in theory, after 2 years, if I were to choose the 2 year US government bond, in theory, after 2 years, I'm going to get my principal back, even if the price of the bond continues to drop. So I'm getting the principal back on my bond after 2 years, and I'm getting paid 4.2% on this 2 year bond. Pretty interesting. So I can earn a 4% plus return while the whole market, whatever I look at, real estate, gold, equities, are selling off. I can earn a plus 4% just by buying some bonds. So I've already started to accumulate bonds, and so that's one thing that you can look at is these bonds as a safe haven area, that if things were to crash, then definitely two things. One, I'm going to earn my yield. Number two, I'm going to get my principal back. And if there's a crash, guess what? If bonds are selling off and shorting bonds have been an overcrowded trade, the reversal, you're going to see bonds completely reverse very quickly, especially if there's recessionary signals or signs that the Fed or the central bank is going to start cutting rates, and you're going to see the short end of the bond curve move up. Now, as a tactical strategy, I started to add more of the long end bonds. So I'm looking at the TLT. TLT follows the long dated US Treasury bonds, and TLTs generally start to move up when there's these recessionary signals. Now, right now, the 30-year bond is still, has sold off quite a bit and hasn't picked up much of a bid aside from yesterday. We had that UK event news came out from the Bank of England. But that's just giving you an example that when recessionary signals start to come in, the TLT in the 30-year bonds will start to move up higher on recessionary signals. And that's your first gauge. That's your first gauge that, okay, something is coming, something is breaking, and people will start buying bonds, and the 30-year bond will start to move first. And then when the central bank comes out and decides that, okay, we're going to go from QT tightening to QE, which is more of an easing stance, then you're going to see that, okay, with QE, you're buying more. The central banks are usually buys more long dated. You will see those long dated bonds do well and move up in price, and especially the like the TLT, like I mentioned. And definitely, if they start cutting rates, then the 2-year example that I gave you, the 2-year bond, will also reverse. And what's going to happen is, this might be a little bit complex, but the yield curve starts to go from an inverted yield curve to now steepening yield curve, because now you've got rates being pulled back to, let's say, 0. And all right, so this is part 2. Sorry about that, video just stopped. So basically, to go back to what I was saying, is that the yield curve would go from a inverted yield curve to basically now a steepening. And that steepening is because the rate cuts are coming, which are going to, if the rate cuts come, then you would have the yields basically go back down close to 0, which would cause the short end, the 2-year bonds, to move up in price, and it would correct the yield curve in such a way that it would go into a steepening mode. So to sum up, the areas where I see and find the opportunities where a sell-off could happen are the following. So in my portfolio, I would, if I'm not touching my long-term portfolio but looking to buy insurances or hedges, number one, we could have cash, right? Accumulate that cash, so that cash is growing, and it could, you could spend on buying opportunities. And this is the easiest, right? This is the easiest. This is the safest, because you're not making a directional bet, right? Because if these go sour, then then you'll lose money on these ones. But if this, if the markets just trade sideways for, next 1, 2, 3, or 5 years or whatever, you'll at least have some cash, and have, an idea that whether the market is ready to turn around or not, and you'll find out from the different types of policies that are there. Now, second that I would have in my portfolio, and we could watch this, right? We could watch this and see how this develops, is the 2-year U.S. government bond. So they're paying about 4%+, right? You buy that, earn your yields, and get your full 100% money principal back. So you can make some money, instead of having your cash sit there, make some money and wait till you get paid after 2 years, and then deploy that money with an extra return that you made into, let's say, equities, if you like. And the other one are TLTs. I'm looking at TLT, and the reason I'm looking at TLT is because of that recession play, that if there is some sort of recession fear or risk off event, then definitely I could see the TLTs really moving up and skyrocketing. And in fact, the long dated bonds, if you start getting central banks, like how the Bank of England is going out and purchasing long dated bonds, that also causes long dated bonds to move up higher. So if the Fed starts doing that, obviously the TLTs will also start to move up as well. And then you've got put options, which are, again, your insurance policies. So you can buy put options on SPY, QQQ, IWM, DIA. So this is something that I would put in my model portfolio. And then the other one is inverse ETF. So you can play it with the SPXU, SQQQ, and there's much other ones as well. Just visit the website, which is etfdb.com. So this website here will have a whole universe of all the ETFs, everything that you want to play, whether it's equities, bonds, commodities, currencies, different geographic regions. You can check out the UK and Europe related funds as well, currency plays as well. So all on this website here, etfdb.com. So this is kind of how I would structure my model portfolio. Again, this is not advice. This is not financial advice. I'm not an investment advisor. I'm not telling you to do this. Please do not take this advice. I could be 100% wrong, but these are some of the ways. And let's track it, right? Let's track and see that did these plays work out after 1 to 2 years. We'll see. But always get a registered investment advisor before making any decision. So hope that answers your question. And if we get more questions in the comments, that would be great. Please leave a comment below. Add your questions, add your comments. Love to start conversation and debate around this topic, whether you agree or disagree with this. Whether you have your opinion on different subjects, on different asset classes, and what you think. Leave a comment below. Let me know what you think. And thanks again for that question. It really sparked my curiosity and interest. And hope to see you guys around. And stay tuned for the next video. Thanks. Cheers. Bye.